Hello, welcome to the industry and legislative briefing for Massachusetts retirement systems with the MassDivest Coalition. My name is Randi.
And I'm Jamie Hall.
And we're really pleased to bring you this presentation today. We've prepared a number of slides and I'm going to share my screen right now so you can see and follow along. So to start, this briefing is specific to fossil fuels, including coal, oil, and gas. And it also talks about state legislation that authorizes a local option to divest from these industries. And Jamie and I are both volunteers. I am a member of the Cambridge retirement system, actually. I worked for 14 years as the recycling director for the city of Cambridge. And I'm currently working with the Rainforest Action Network on the Ensure Our Future campaign. And I'm a volunteer as political director with the MassDivest Coalition.
And I'm a resident of Somerville. I'm a volunteer with both MassDivest and Fossil Free Somerville. And I work as an energy economist at Synapse Energy Economics in Cambridge, Massachusetts.
So you might be asking, who is the MassDivest Coalition? We're a statewide coalition working to divest pension funds in Massachusetts from fossil fuels. Last year, we merged with Fossil Free Somerville to work together to advance the issue at the state level. And we've been around for about 6 years. And I'll say we are doing our very best to present accurate information in this presentation. So if there's anything that you find to be incorrect, we would love to hear from you. Please email us at info@massdivest.org. Also, in the PDF that we'll send of this slide deck, you can click on many of the images and links to get more information. So why are we doing this? One, we want to protect retirees and the financial health of pension portfolios. And second, we want to share information with you about current legislation that would provide a local option to retirement systems to divest from fossil fuels, and we want to share an update on the industry. Lastly, April 23rd is a national day of action for a national campaign called Stop the Money Pipeline, which is targeting institutional investors like pensions and endowments, asset managers, banks, insurance companies, and others to stop financing the fossil fuel sector, which is one of the most important ways that we can address the climate crisis. So our agenda for the briefing is to go over the state of the fossil fuel industry, to share about the global divestment movement and support that exists in Massachusetts. We want to share a local story about the Somerville Retirement Board and their interest and efforts to divest from fossil fuels. And we want to go over our local option fossil fuel divestment bill, which is currently in the state legislature, House Bill 4440, and talk about who is eligible to divest from fossil fuels if this bill is passed. And lastly, we want to talk about how to stay in touch and to contact us.
So let's start with the state of the fossil fuel industry. The fossil fuel industry has been performing poorly for about the past decade, and you'll be hearing more about that throughout this presentation. But to start us off, this slide documents a few reasons why that is. One is that there are many global climate policies that are driving or even mandating the low carbon transition to a lower or zero carbon future to meet the Paris goals to limit global warming to 1.5 degrees Celsius. The coal industry in the U.S. and around the world has performed very poorly economically because they're expensive to run and they are being outcompeted by renewables. Gas is not clean, and as you'll hear more about, it's not a necessary bridge fuel. Renewables, on the other hand, like wind and solar, are more affordable and becoming more affordable every year. The costs keep coming down. And there's been many developments in battery storage technology that ensures system reliability, and battery storage combined with renewables are emerging as a real powerful and economically prudent combination of technologies. A few other reasons why we've been seeing the fossil fuel industry performing poorly. The geopolitics of the industry causes a lot of volatility and uncertainty and leads to some risk. Young investors are also driving this trend. They believe that fossil fuel companies can't be sustainable and they aren't interested in investing in those companies. And lastly, a much more recent impact behind this is COVID-19, which has been driving down oil demand and worsening the plummet in oil prices. And today it's April 20th when we're recording this, and we actually are seeing oil prices go negative today, which is a pretty crazy phenomenon. So next we're going to hear from a renowned expert in the field, Tom Sanzillo. He's the Director of Finance at the Institute for Energy Economics and Financial Analysis, which is also known as IEFA. He has 30 years of experience in public and private finance. During that time, for part of that time, he was the first Deputy Comptroller of New York State, where he held oversight of a $156 billion pension fund and also $200 billion as well as $200 billion in municipal bond programs. So this video that you're about to see is from June 2019, when we held a legislative briefing for the local option bill that we'll be talking about. The legislative briefing was attended by over 40 offices with legislators from both the House and the Senate. And let's dive into it.
And to me, the question is not whether or not to divest. The question is why you're there in the first place. If you I managed a couple of very large pension funds in my career. They were both very solid, and the names of them even after I left, and that's great. And I made a lot of money with fossil fuel companies. So this is today. This is like the beginning. This is the stock market this year. All those little squiggly lines are different sectors of the economy. The red one in the middle is the Standard & Poor's 500. The light blue one near the bottom, that's fossil fuels. That's below the Standard & Poor's 500. For the first 6 months of this year, they're at the bottom, right? It means they're making less than everybody else. That used to be, that big brown line at the top, that used to be fossil fuels. That was fossil fuels for the time up until maybe the beginning of the 90s, from the 60s on. So they dominated it, they contributed immensely to all of your pension funds, and that is what we think, that is what they want us to think will return. In 1980, that blue line by energy, they were almost 30% of the pension funds that I managed when I first came into them. And they were making 20–30% a year, and those returns were enormous, and they drove the index, they drove the indexes, they drove the fund, they drove actually other investments as well in the fund that were outside the stock market that we got involved with them in. And today, it's about 5%. So over that period of time, the rest of the economy grew, and the energy sector shrunk. And the reason they shrunk is that in the 80s, they were high risk and high return. Today, they remain high risk, actually even higher risk given climate change, and low returns. And that's why they sunk to this level. So one of the leading CEOs said this last Friday. He says, "The technological advances developed by the industry have been the cause of its slow suicide." There will be a reckoning, and the only question is whether it happens in a controlled manner or whether it comes as an unexpected shock to the system. That is a man in the largest fracking company in the United States, and the former CEO, even though he's talking about it's not just stuff we're making up. These guys are in trouble. They will remain in trouble. And if you think about what I showed you in terms of having a whole industry that's lagging the market, like at the bottom, and somebody tells you, you're going to lose money, the question is how? Because you can invest in anything else and make more money. And to me, the question is not whether or not to divest. The question is why you're there in the first place. If you have a sector that has poorly performed for over a decade, and it looks like it's going to get worse, why are you even there? Why aren't you making the moves to get out?
All right.
Yeah, thanks for that, Tom Sanzillo. That's I always find that to be a pretty incredible video with some pretty strong arguments being made. So moving on now, we've talked about and we've heard from Tom Sanzillo about the recent performance of fossil fuel companies, but you may be asking yourself, is divestment effective? Is it an effective strategy? And are these pressure campaigns having any impact on corporations? Are they working? And I'll note that fossil fuel divestment campaigns have been active for nearly 10 years, and the answer is that yes, they have been very effective. This slide has a couple of examples. So first up, we have Jim Cramer, who's a very well-known stock analyst and a money manager. He has a show, Mad Money, and recently he said that he's done with fossil fuel stocks and a bunch of other things related to that, which we'll watch in just a moment because it's a pretty good video. But before we get to that, I'll just note the two other examples that we have on this slide. Shell noted in 2017 three relevant issues in its annual report. It talked about divestment and climate litigation being material risks to the company's bottom line, and it notes greenhouse gas emission regulation, fossil fuel divestment, and legal challenges in its 2017 annual report. Then even more recently, Norway's sovereign wealth fund, which manages $1 trillion in assets, has the go-ahead for the largest fossil fuel divestment effort to date by dropping more than 13 billion of investments in fossil fuels. And that includes 8 coal companies and 150 oil producers. So some pretty staggering moves recently. And we'll now go back to Jim Cramer of Mad Money and to see what he has to say about fossil fuels.
What about the two big oil companies, Exxon and Chevron today? Both of them drags on the Dow right now.
I know that Mike won't want to hear this, but I'm done with fossil fuels. They're done. Yeah, they're just done. We're starting to see divestment all over the world. We're starting to see the companies just regard them as, big pension funds saying, listen, we're not going to own them anymore. It doesn't matter how good they are.
Do you think that's the biggest thing holding these guys back, and not necessarily just oil production here in the United States?
Absolutely. I think it is. You could say, listen, China, obviously swing market. No, the world's changed. There's new managers. They don't want to hear whether these are good or bad. Look at BP. It's a solid yield, very good. Look at Chevron buying back $5 billion worth of stock. Nobody cares. And this has to do with new kinds of money managers who, frankly, just want to appease younger people who believe that you can't ever make a fossil fuel company sustainable. That's why I said Mike Wirth's trying everything he can, but in the end, they make fossil fuels. And that's going to be, we're in the death knell phase. I know that's very
death knell phase for the stocks, but not for the death knell phase for us using fossil fuels, right?
Yep. Well, I think that the issue is sustainability. Look, this is the other side of Tesla. These stocks don't want to be owned by younger people. Their dividends are great. These companies are doing better than obviously when oil was at even 4 years ago when oil was at 26, 27. But you can tell that the world's turned on them. And it's actually kind of happening very quickly. You're seeing divestiture by a lot of different funds. It's going to be a parade. It's going to be a parade that says, look, these are tobacco, and we're not going to own them.
Wow. That's a really tough stream to swim against.
They're tobacco.
If that's the case.
I think they're tobacco. We're in a new world. And some of us could be kicking and screaming to even believe that could be the case, but they're tobacco.
All right.
All right. Bear with us while we reorient here. Okay.
So this slide here includes a list of a bunch of other leading articles and reports that we've compiled from all sorts of different sources, talking about this trend of divestment and fossil fuel performance. I'm not going to go through each of them, but they're all really interesting and good reads, and I encourage you to dive into them. But just to point out a few, up at the top, we have an IEFA update, which notes that oil and gas stocks placed dead last in 2019 again. Under that, we have BlackRock saying that the climate crisis will now guide its investments. We have some interesting articles on New York City taking major next steps on divestment. The New York State Common Retirement Fund paying $22 billion for holding on to fossil fuel stocks. So that's that's a cost that they are paying by holding on to it, essentially, and a whole bunch of other interesting sources and reports for your perusal.
So moving forward, we want to talk to you about the global divestment movement. And to start, I want to share a concept that I find very helpful. This graphic was developed by the Rocky Mountain Institute for their 2018 report called Reinventing Climate Finance. So think of the global economy as a bathtub. There are dirty flows, a dirty faucet, which one way we can address that, slowing investments in new fossil fuel infrastructure or phasing out fossil fuel subsidies. Then you have the clean faucet, which is investing in renewables like wind and solar. Then you have the drain, which is a way to retire capital stock. And we can speed up how fast the dirty water drains out of the tub by retiring coal plants early and phasing out combustion vehicles, which we're seeing in Europe. And then lastly, we can look at the size of the tub or the size of the capital stock that we have. And one way to use this as a lever is to improve efficiency of the existing infrastructure and reduce the need for new power capacity. So divestment is a way to turn off the flow of dirty water, and it also helps to drain the tub. And this is especially helpful when we think about how the movement is growing. So now there's over 1,000 organizations around the world with over $12 trillion in assets that have committed to divesting in whole or in part. In addition, the National Stop the Money Pipeline campaign, which we have their logo down in the corner here, was launched in January and pulls together several corporate target campaigns. They're aimed at, and so I think of this as a four-legged stool. The first leg is asset managers, and this campaign is focusing on BlackRock, the world's largest investor in fossil fuels, especially coal, and they manage many of the funds in Massachusetts. Banks as well, and the campaign is focusing on JP Morgan Chase, the world's largest funder of fossil fuel projects. Insurers, with a focus on Boston-based Liberty Mutual, which is a major insurer of fossil fuel projects. And lastly, institutional investors like pensions, which is why we're talking to you today, and endowments. So let's just go over some reasons why we believe that it's time to divest from fossil fuels, kind of summarizing what we've been talking about. So first, and most importantly, from a financial standpoint for fiduciaries, it's financially prudent. As we've heard so far, investments in fossil fuels are now high risk and low return, and pensions should avoid further losses by eliminating exposure to this volatile sector. Secondly, we believe that it's important to divest to avoid legal risk. So as you may know, some of the biggest oil and gas companies are embroiled in legal disputes with cities and states and even children over the industry's role in global warming. So these kinds of litigation suits increases the financial risk for investors. And lastly, there's the moral imperative. Air pollution and climate change are major public health issues, and globally, millions are dying annually from air pollution from the burning of fossil fuels. So it's important that we ensure a livable planet now and in the future. So if you have heard, the Attorney General is suing ExxonMobil for deceiving Massachusetts consumers and investors. This is a really significant lawsuit. And Massachusetts investors that hold ExxonMobil common stock include State Street, Wellington Management, Fidelity, and Boston Trust, Walden Company, and those affiliates. And if you are interested, you can click on the complaint. It's over 200 pages and has a wealth of information that is the result of extremely diligent research by the Attorney General's office. They are suing this oil company for basically lying to investors. On the financial side, they are talking about two ways that Exxon has lied to Massachusetts shareholders. First, that Exxon, by failing to disclose its knowledge of the systemic financial risk of climate change to the global economy and to Exxon's fossil fuel business. Exxon knew in 1980 that the projected rise in global temperatures caused by burning fossil fuels would have major economic consequences and even bring world economic growth to a halt. The second reason that the Attorney General lists as a way that Exxon lied to investors is that since 2007, the company illegally misrepresented to its investors that it had factored in to its financial planning and investment decisions the cost of complying with carbon regulations, the so-called proxy cost of carbon, when internal documents show that it has not done so. This deception misled Massachusetts investors by inflating the value of the company's portfolio of oil and gas projects around the world, including its high cost and heavy polluting oil sand assets in Western Canada. So given that Exxon is pretty representative of the industry overall, we must ask ourselves as investors, how can we trust them and why would we want to keep investments with a company that conducts itself in this manner? So moving on, in Massachusetts, there is a significant amount of support for fossil fuel divestment, including institutions and foundations that have divested in whole or in part. I want to share two quick stories pointing out the University of Massachusetts. In 2016, they became the first major public university in the nation to fully divest their $770 million endowment. And here's a quote from the foundation treasurer and investment committee chairman, Edward D'Elio. "Divesting from investments in any particular sector is not done lightly, and we have done so rarely. The foundation's primary responsibility is a fiduciary one. Its primary mission in overseeing the endowment in an effort to maximize returns on funds donated for research, academic programs, financial aid, and other purposes. That we took this step reflects not just our comfort as fiduciaries, but the seriousness with which we see climate change." And many foundations have divested from fossil fuels as well, each spending months researching and deliberating the process. which requires looking at existing holdings, examining the foundation's core mission, and thinking about long-term risks and investment goals amid growing concerns about volatility in the fossil fuel market and stranded assets on balance sheets if the values of fossil fuel companies decline. And here's a quote from Olivia Farr, chairman of the John Merck Fund, which is based in Boston. She said, "We believe that we've got to respond to the crisis of climate change with every asset available. To date, they were 97% divested from fossil fuels and utilities and are reinvesting in clean tech. We are hoping to fund the transition to a clean economy." Last here, several organizations in Massachusetts have endorsed the local option fossil fuel divestment bill that we'll talk more about soon, including Mass Power Forward, which is a coalition of over 200 environmental groups, community development organizations, and clean energy businesses, faith groups, and neighborhood advocacy groups. We were also endorsed by the Climate Action Business Association, whose business network includes many companies from the financial sector with expertise in investing successfully with sustainability in mind, such as Trillium Asset Management, Balance Rock Investment Advisors, Green Century Funds, Eastern Bank, North Star Asset Management, and Progressive Asset Management.
All right, so we've taken a wide view, starting with the fossil fuel industry, looking at its performance. Then we looked at global divestment. We've since narrowed in on Massachusetts local divestment efforts. And now let's get even more narrow, looking at a very local story, the Somerville Retirement Board. So this slide shows a timeline of the Somerville Retirement Board's decision and its ability to divest from fossil fuels. In 2014, there emerged a grassroots campaign to encourage the Somerville Retirement Board, the SRB, to divest from fossil fuels. And that campaign continued for about 3 years, when in 2017, after a whole bunch of thorough research and analysis, the SRB was convinced and came to the conclusion that divestment made a lot of financial sense. It's financially prudent. And it then moved $9.2 million in its assets to a fossil-free fund. The fossil-free funds, it used the Carbon Underground 200, which compiles and maintains a fossil-free index, and it identifies the top 100 coal and 100 oil and gas publicly traded reserve holders globally. Those are ranked by the potential carbon emission contents of their reported reserves. And the fund excludes those Carbon Underground 200 companies. So the SRB moved $9.2 million to that fund, but 2 months later, the PARAC made them reverse that decision, and the SRB had to reinvest that $9.2 million back into funds that included fossil fuel stocks. Then in 2018, which was the last legislative session, Somerville filed a home rule petition to allow them to divest, and it was rejected, but the Joint Committee on Public Service offered suggestions to the home rule petition, which has since led to a new bill in 2019, this current legislative session, and that's the local option fossil fuel divestment bill, which you've been hearing about. It was filed in 2019, and it would allow, if it passes, any eligible retirement system to divest from fossil fuels if they chose to. It's a local option, so it doesn't mandate anything. It simply allows retirement systems like the SRB to retire if they came to the conclusion that it was financially prudent for them to do so. Most recently in 2020, very excitedly, the Joint Committee on Public Service voted just in February to move the bill favorably out of committee, and as of April, it's on the orders of the day. So, as I mentioned, the Somerville Retirement Board divested and then had to reinvest. And that prompted a question for us at MassDivest and Fossil Free Somerville. We were wondering if they had been allowed to remain divested, how much more money would they have made? So we pulled the financial returns of the S&P 500, as well as the stocks in the fossil free fund, which here we call the S&P 500 excluding fossil fuels. And we trace them over the time period between July 2017, which is when the SRB had to reinvest in fossil fuel stocks, and June 2019, which is when we conducted the analysis. And we found that the S&P 500 excluding fossil fuels, so if you get rid of all those Carbon Underground 200 stocks, it would have achieved a return of 24.1% between July 2017 and June 2019. In comparison, the S&P 500 produced a return of 19.1%. Therefore, we conclude that Somerville's fossil-free fund would have achieved 5% higher returns than the S&P 500. That's 500 basis points, a whole 500 basis points more than the S&P 500, simply by excluding the Carbon Underground 200 oil, gas, and coal companies stocks. And the figure that we include here is from our white paper, which we encourage you to go and check out. It has a bunch of other statistics and analysis included in it. But this figure shows that it's a much longer trend. This graph goes back to 2014, and it shows that top line, that's the performance of the S&P 500 excluding fossil fuels. And the line on the bottom is the S&P 500, and you see over time, the gap between the returns of the two funds keeps getting wider. So next we'll talk a bit about funded ratios, which we know you all know quite a bit about. We did some research and we found that many of Massachusetts retirement boards have funded ratios that are well between 100%. 100% would mean the funds are fully funded, and yeah, quite a few Massachusetts retirement board have ratios below 100%, including, actually all of them do, including Somerville, which has a funded ratio of 62.7%. And so we make the argument based on our past finding in the case study that fossil fuel divestment is a really good tool and tactic and strategy to help generate increased returns, which can then help improve a system's funded ratio. If it increases the returns of a portfolio compared to the S&P 500, and therefore it can bring that funded ratio up higher.
So shifting gears to get into more details about the House Bill 4440. As you have heard, this is an act authorizing independent retirement systems to divest from fossil fuels if they choose to. That's the option part. It is not a mandate. It is just an authorization bill. It was filed in the House by Dylan Fernandez and Jay Livingstone, and in the Senate by Mark Pacheco. Currently, the bill has over 80 co-sponsors and supporters in the House and State Senate, and together, these legislators represent 64% of the 104 retirement systems in the state. And I would just note that there's support from legislators in every county in Massachusetts. And the House legislators have consulted with PERAC, the Public Employee Retirement Administration Commission, on the local option fossil fuel divestment bill specifically. Rep. Fernandez met with PERAC as well as the Mass Municipal Association in May of last year, and PERAC requested language in the bill that protects retirement board members from legal liability for not choosing specific investments, so that has been included. And Rep. Paracella, who is House Chairman of the Joint Committee on Public Service, spoke with PERAC several times during the legislative session to discuss various aspects of the bill and ultimately, he recommended that the Public Service Committee vote H4440 favorably out of committee, which we've said he was done so in February this year. That was a huge step forward in the legislative process. And as we've mentioned now, the bill is on orders of the day, awaiting a vote in formal House session. So, oh, Jamie.
Mm-hmm. So the Treasurer Goldberg's office requested text in the local option bill, and the most recent version of the bill, the one that's moving forward, reflects those changes, and it specifies that the local option bill does not apply to any, quote, participating system. Those are systems whose assets are fully invested in the Massachusetts Pension Reserves Investment Trust, also known as PRIT. PRIT is managed by the Pension Reserves Investment Management Board, which is also known as PRIM. And PRIM could choose to divest if they chose to, because it's not subject to oversight by PARAC. And therefore, the local option bill applies instead to purchasing systems, and those or fully independent systems, and the assets which they maintain direct control of with their investment managers. And a purchasing system is, again, a system that has some of its assets managed by PRIM, but also maintains independence over some of its other assets. We'll note that the Massachusetts Teachers Association and the Boston Teachers Union both support fossil fuel divestment, and they're both fully invested in PRIT, which again is managed by PRIM.
So on November 18th, as we've mentioned, last year the Joint Committee on Public Service held a hearing on investments, and H4440 was on the docket. In advance of the hearing, dozens of people submitted written testimony in favor, including 2 members of the Somerville Retirement Board, Ed Bean and Michael Masrabani. At the hearing, MassDivest invited many people to testify, from supportive unions, climate organizations, and local elected officials, including Mayor Curtatone from Somerville. If you're interested in watching this testimony, this slide shows some of the videos that are on our MassDivest Coalition's Facebook page, where you can watch and listen to testimony from that day. So which pensions are eligible systems? As Jamie talked about a couple slides ago, it's both independent systems, which control all of their assets, and purchasing systems, which control some of their assets. And to emphasize that the systems that are authorized by the bill can divest their assets, only they can divest for the assets that they maintain control over. So for example, if a purchasing system has some of their assets with PRIM, clearly those assets are continuing to be managed by PRIM. So it's just the assets that your retirement systems directly control. So we've listed those here to the best of our knowledge from what is listed on the PRIM website. And any of the communities that are underlined here actually passed a resolution in support of fossil fuel divestment.
So how many employees are in the eligible systems, those that are purchasing or fully independent? We've calculated the numbers, and there's 145,352 active and retired employees in those systems. It varies quite a bit by system, but the average number of employees is a little over 2,138. And the largest is Boston, which has 24,166 employees. We just want to note that there's quite a bit of union support for fossil fuel divestment, including SEIU Local 509, SEIU 1199, SEIU Local 888, Massachusetts Nurses Association, Boston Teachers Union, and the Massachusetts Teachers Association. And SEIU local represents 8,500 public service workers, and many of those are municipal workers. And yeah, there's quite a bit of union support behind this as well.
And Jamie, I would add that it's local 888, which represents a lot of municipal workers. Actually.
Right.
Yeah.
Yep. Thank you for that, Randi. So how much is an average pension portfolio invested in fossil fuels? We've reviewed the Somerville and Cambridge Retirement Board portfolios, and based on those portfolios, we estimate it's up to 4% of the portfolio. That's millions of dollars for each eligible system. It varies by how much money is in each system, but it comes out to millions of dollars per system. And the total invested amount in fossil fuels across all of the eligible systems is up to $3 billion. If the bill passes, then those assets can be divested if the retirement systems choose to move forward with divestment.
So we want to continue the conversation with you, and we want to ask that you consider inviting MassDivest to an upcoming retirement board meeting. We encourage you to understand how this authorization bill would give you the option to divest from fossil fuels and increase your suite of choices for investment. We encourage you to ask your asset managers what the fossil fuel holdings are in their funds that they manage for you, and then we can help you compare the returns by divesting on your portfolio. And lastly, we want to encourage you to think about and continue to think about, because clearly this is in your mission, to protect your retirees and the health of your investments by identifying climate-related financial risk. So this has been a wonderful opportunity to share information with you. If you would like to get in touch with us, here are our emails. And again, there is our Facebook page, which we encourage you to check out with the videos from our testimony and other headlines that are very relevant to the changing aspect of the fossil fuel industry. And I will stop my screen share right now, and so that we can say goodbye to you guys. So,
Thanks. Thank you so much for tuning in, everyone.
Thank you.